Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, traders and investors. Welcome to Thursday's edition of Benzinga's PreMarket Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elconin, along with Dennis Dick, Chris DeScarlis, working the boards here. And we got a jam-packed show for you today. We're going to recap Dennis's call for the 1,000-point rally yesterday. We're going to look at the overall market and assess the damage being done here this morning after the big rally. We'll break down the stocks in the S&P 500, the top 10 components that make up 23% of that index. And slew of guests for you today, 8:35. Ivan Feinseth is coming on, but before that, Marc Chaikin at 8:15. Gene Munster's going to pop in. He did his year in review and predictions for 19. He'll come on at 8:50, and then later on, a couple special guests popping in. Got to talk to Fari before I go on vacation. Fari at 9 a.m. and Ryan Craver at 9:15. So I'm going to need a nap after this, but we're going to play a clip for you here. And you guys like predictions, and you like us to say things where we're going. So Dennis kind of stuck his neck out on the line yesterday, and we're gonna play a little clip from yesterday's show. Chris, hit it.
In gold. So I think the only thing I have left, I have a little bit of silver left, but I have almost no gold exposure. It's less than 1% of my overall portfolio. And I've not been a gold fan for a while. Obviously, I've been wrong because gold has had a nice rally. That's market related, though. I don't think it's because everybody all of a sudden, likes gold again, just market related. So gold catches a bid when the market goes into the doldrums, and it has. But I think there's better hedges out there. If you're nervous about the market, you're that nervous and you want to have gold, and you get short stocks. I mean, it's go down a lot faster than gold goes up.
That's for sure. All right.
But I think you're way late to that party now. I think if you're coming here and shorting stocks now, you're asking to get your face ripped off. I think we're late. I think we're going to have one of the, I'll predict.
Prediction
This is a
time.
prediction here. I don't know when it's going to happen, but by the end of the year, so I'm going to say within the next, what do we have? 4 trading days left this year? 3, 4?
Wednesday, Thursday,
how many left?
Friday, Monday. 4.
4 trading days. We're going to have like 1,000-point Dow rally one of these days. So it's going to be one of the biggest rallies ever. It's going to get major headlines. It's because we're just so oversold. So does that change anything? Does that make me want to go and buy stocks right now? No, because I don't know how long it's even going to hold. I think there's going to be a lot of people. Probably be selling that rally. But I think we're going to have a major rip your face off rally coming here in the next few days because it's too easy for the shorts.
I agree with you. All right, Dennis, all right, let's bring in Triple D. And were you out there? Were you just out there buying hand over fist yesterday and then flipped it at the close?
And you know what? I'm so disappointed here. So here, obviously, I called the rally, and I was actually traveling yesterday, so I really didn't get to participate. But I thought, okay, I'm going to come in here this morning and sell a bunch of stocks out of my portfolio. And everybody beat me to it. I mean, we're already down 400 points. They're really, I called the rally, and I said that they're probably going to be selling into it. I did not think they're going to be selling into it in the pre-market the very next day. I thought maybe you get a little follow through here. I do think the sellers were still going to come in, but holy cow, these sellers came in quick. So, I mean, this is a tough market to predict here and now. I'm not going to even make any predictions here today. The only thing I will predict for today is volatility.
And that is not a hard prediction at all. Just let me recap. The S&P's 2481.50. That's your high. That exceeded the high yesterday by just 4 points at 77.75. Coming on the downside here, I was a little frustrated at the markets. I did cover a few shorts on the close yesterday. Just couldn't take the pain, and I just have a daily pivot at 21.75. Current low is 22.50, but I'll do the math a little bit later. We had what do we have? Like 160-point rally, so 80 on the low. So mid-range of that rally would probably be right about 2,400. But you know what, Dennis? I have a prediction to make too. And I don't know if it's a prediction or a little or a little open-ended statement, but until we take out yesterday's high and the current high, which is 60 handles away, this market's in trouble. If I am staying permanently bearish until we close, because that was just a silly rally yesterday. Now you call it a double top at 24.80. If the market cannot recoup 24.80 on the hop, then I think there's nothing but downside. Take out that 23.16, 17 low, 2,200, 2,100, 2,000, whatever. That's your bogey. That's what yep. That's what
Joel's got the full bear hat on here. I'm mixed.
Okay.
So, obviously I put my bull hat on for a day and I thought this rally was going to come. I didn't know it was going to come yesterday, but I said by the end of the year, so within the next 3 days, we're going to rally 1,000 Dow points, which we did. So I got it on that day. But I just look at this now and I can see it two ways. So it's really hard here. You can see it that, okay, anybody who's short got their face ripped off yesterday, just as I said that was going to happen eventually. So they're probably looking to maybe bring these shorts in here on the open, which could help. But you still so many people underwater. And obviously what we're seeing here overnight is that there's so many people who want out of stocks, that they see the big rally. You've got people with a day job come in, they get home at 5 o'clock, they see what the markets did. They're calling their broker, this morning and saying, sell, get me out. And that's what I think you're seeing this morning is, and not only that, the institutional traders that are way overweight are saying, okay, this is my opportunity. I got it late now. And I was saying the same thing. I wanted a rally to sell into too. I thought it would hold a little bit longer than it did, but unbelievable that we're already down, 400 Dow points here and giving back 40% of the rally that we had yesterday. Let's see what it does. This is the most important day for the market. I'm going to say right now, because like Joel says, if we can just find the buyers and get back up near those highs and take them out, then okay, then we got something cooking. But if we just keep leaking here and we end up giving back 1,000-point rally over the next few days, that is terrible news for the market. And I'm also going to say is there's still a lot of people, and I think we said this a few days ago, there's a lot of people, Main Street, not Wall Street. Wall Street knows what's been going on. Main Street, when I'm talking to, people, even over Christmas here, I had some Christmas meals, people don't even know the market got hit. Because it's just been slow, steady down. Main Street, your blue collar workers don't even realize they got their quarterly statements at the end of September. The people who aren't involved, the people who are in mutual funds, the people who are, passively invested in the market don't realize that their retirement accounts went down 20% in the last quarter. They're going to find out when they get those quarterly statements at the beginning of January, and they're going to be like, what the hell happened? And that could get a whole new bunch of sellers coming in. Because, at the bottom line, it's Main Street that does own a lot of stocks through the retirement accounts, through the pension accounts, through whatever. So when you think about it, there's a lot of people here who are still kind of in the dark. And when they see, that the quarter is down 17 or 18 or 20%, they're going to come with their selling shoes on January 2. So let's see what happens here. Maybe this market, can rally back here and have a good couple of days. And, Santa Claus rally maybe be the best one ever. Sure got a good start yesterday, but I'll say the jury is still out on this rally.
Right. And we did get some weak numbers, I believe, out of the Richmond Fed yesterday. I believe another, maybe it was the Empire State Index, and, indicating that the Fed's model might not be correct. And I'm kind of, man, if I have to take off my bear hat and put my bull hat on, I would just say, man, are we going into a full blown recession after a, cracking up 3% GDP? Looking around Detroit, looking around the Motor City, looking around the area that I live in, people are just, they must be just buying the top and building the top, because there is still, growth here. Of course, Detroit, went down, before the rest of the country as far as the recession goes. So, boy, hopefully it so goes Detroit, so goes the market. But right now, just on a technical basis, I'd really like to see us, clear that 24.80 and then the 50% retracement of the move. We'll figure that. I should actually probably figure that out exactly here when we get a quick break. But that will be an important level to hold here. A lot of pockets. I'm seeing all red on the screen here, Dennis. I'm not seeing. I see tires.
Yeah, it's all red. I'm looking at my
pre-market
filter. Okay, so there's a few stocks. Yesterday, like I was saying, there was almost no stocks in the down filter. There is almost no stocks in the up filter, so a little reverse of yesterday. I do see Carnival Cruise Lines, it's trading in the green. CCL, you've got some gold stocks trading in the green. Silver's trading up, gold's trading up. We know that. If you move away from there, it's slim pickings to find a green stock. And the red is everything. So across the board, it's funny, you know, we talk, you know, sometimes the defensive stocks, Coca-Cola, Procter & Gamble, but that has totally, you know, moved away, and they've been selling those stocks with the overall market, and those are moving with the market now over the course of the last 4 days, which we predicted that as well. When everybody's piling in Procter & Gamble at $95, we said a week and a half ago, these are not as safe as you think they are. And if these markets starts to get ugly, they start selling everything. It's exactly what they did. It took a Johnson & Johnson, you know, bad news for that company itself, obviously, to really, you know, get the defensive stocks hit. But that was really what kickstarted it. People realized that, hey, you know, my money's not safe anywhere, and they started selling everything. So you look here and you think, okay, maybe, you know, it's tough. It's going to be a tough prediction here today. This is going to be a wild one. You know, we are finding a few buyers. We've just rallied here a little bit again.
Just rallied 12 points.
Yeah, we just had 12 handles here in the last 5 minutes. So we're going to be wild. That's all we know. And I would say, you know, if you get any stocks near, you know, or if you start peeling back, you know, you get stocks near yesterday's low, obviously, those are going to be interesting. You get stocks near yesterday's high. Those are going to be interesting spots to play the short side. Take out those highs from yesterday, then we really got something cooking. Let's see if we can do that. It's good news that they are finding some buyers here, at least right now. I don't know if something was said here a few minutes ago, up 12, you know, from where we just were when we started the show, but there's still a lot of work to be done to get the bears out or back into hibernation.
Looking at the S&P here, 50% retracement of this move is 23.99. So let's just call 2,400. You know, the big level. That's the 50% retracement. We're 40 handles away from that. We're 40 handles away from the high. So we will let the market battle it out. Spice wants to know, I'm a technical trader. Why are you bringing in fundamentals in the equation now? Well, I don't technically trade my portfolio. I try and base that on the fundamentals. So we kind of try and wear a few different hats on the show. So Dennis, any individual movers here? We have Marc Chaikin coming up here in a few minutes. Is there anything you want to cover?
I mean, the news is very light. You don't have any analyst action at all. You had Ashland getting upgraded, JP Morgan. So this is typically your lightest news. Everybody's on vacation. So, you know, and that's also a thing to consider, is that the liquidity is less. That's why you get these wild swings, is that there is a lot of people taking breaks here right now. So, but if you look in, the banks are getting hit a little bit. It seems equal almost. When I look, I don't see any standout like, whoa, they're really knocking tech or they're really knocking the retail. I mean, yeah, Square's down 1.27%, but it's amazing. You know, Amazon's down 1%. It's amazing that everything seems to be almost going in unison here today. So it's not like, whoa, it's the financials taking us out, or whoa, you know, McDonald's is down 1.1%. It's very, it's a weird day because it seems like everything is just moving together, no matter what the stock is. Procter & Gamble trading down 1%. So, you know, the market down 1.22%. So where we often see, you know, a lot of different moves and it all adds up to the S&P at the end of the day, seems like everything is kind of just down 1% here right now.
All right,
so
we're going to take a break here in 20 seconds, Dennis, but FDX, is FDX a buy at this point? I would say 157.50. Yeah, it's a buy, but if you're trying it for a swing trade, yesterday's low, 150.94. I think you got maybe
long-term buy is what he's saying.
Yeah.
I think FedEx is cheap too. And I said this one on the show yesterday. This was one of my candidates, you know, on the pullbacks there. I said this is one that if I had 100% cash, I'd be nibbling into a stock like this. I still think, you know, I think FedEx 150. I think if you got a 3, 4, 5 year time horizon on this money, I don't think you can go wrong with
Let's go to.
Let's see if the Amazon's taking them out.
Let's see what Marc Chaikin has to say.
Bring him in.
Yeah. All right. Quick break.
We bring him in on the fly.
We're gonna do it. We're gonna bring in take a quick break
All right,
here.
Joel's nervous.
Let's see if Chris. I'm not doing it. We'll see if Chris can do it within 30 seconds here. We'll be right back. Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro, co-host Joel Elconin, along with Dennis Dick, and we are joined by Marc Chaikin. He's the founder of Chaikin Analytics, a 40-year veteran of Wall Street. Marc, help us make some sense out of these crazy markets.
They are unique, and the reason is that for the first time in my career, except for Jimmy Carter, we've got a crisis of confidence in Washington. You've got a lot of uncertainty. I don't think that the targets that people have put on the backs of the Fed or the trade negotiations really mean that much, because we are making progress in those areas. But I think there is a crisis of confidence in Washington. And with the government shut down, the buyers have gone on strike. And you've got thin markets because of the holidays. So Monday's decline, nobody was in on Monday. And yesterday, the desks were thinly populated. Today is going to be a bigger test of what real buyers and sellers are going to be doing.
Yeah, well, Marc, what do you make? Okay, so we had, such a significant sell-off. We were due for a bounce. And, I don't know if you heard yesterday, but I was like saying we could get like 1,000-point Dow rally. I said it yesterday morning on the show because we were oversold. So it wasn't even that bold of a call because it was so oversold. We were due for a big rally. We get this rally here now. But you come in here this morning and there's already sellers trying to come into this rally here again. Is this, did we see a bottom here? Do you think we saw a bottom 2 days ago now that we're, rally 1,000 points off the low? Or do you think this is going to be a process here yet and there's just too much uncertainty to say that, the bottom is in?
I think there's too much uncertainty to say that the bottom is in. I'm likening this to 1987. We didn't have a recession, but interest rates were going up. There was no sign of a recession. We had something called portfolio insurance, which
Yep.
Had to be unwound, and it basically took some big people to the cleaners. We were down 22% in one day. We've done the equivalent of that in 10 days here, or 4 weeks. So I think it's a process. In 1987, after that horrible Monday, you had a couple of failed rallies, and then the ultimate low was in December, but with a lot less selling pressure. The reason I think it's a process, you had a tell here at 3:30. The market's in trouble when your internal clock gets you up at 3:30 if you're Marc Chaikin, to see what's going on in the European markets.
Yeah.
Right?
Yeah.
And the European markets didn't bite on this. The DAX, I think, was up briefly, but the DAX is now down 2.3% and FTSE's down 1.37%. So the European markets didn't bite. The Nikkei is the only market that's participated. So it's not surprising that we get the pullback. I think what's happening is that the natural buyers are on the sidelines. Now, I don't even know who the natural buyers are anymore. We had $87 billion flee from equity ETFs and mutual funds in the 2 weeks that ended last Wednesday. And Thursday and Friday contributed probably another $14 billion. So you had $100 billion. And it came out of bond funds as well. So that money eventually will find its way back into the market. But put yourself in the position of someone sitting on cash. Why would you put it to work today?
Right, chasing. You're chasing 1,000-point rally if you're putting it to work today.
You're putting a lot of confidence in that.
Or even yesterday, because you've got to be prepared for additional pain. So, we used to have an expression on Wall Street, you don't want to catch a falling knife. Here, you're catching a falling safe. There's no, and I don't mean this to scare people, because we're trying to tell people that fear is your friend, but this is such an unusual time. And I'll go back to the crisis of confidence in Washington. I think you know me. I never bring politics.
I know, Marc, and I want to go back to that point that you made, and it's something that really no one is saying on Wall Street: a crisis of confidence in the White House. I mean, that is a very huge statement to make, and I know you try and follow your indicators and stuff, and Chaikin Analytics and stuff, but that's kind of the way I felt from day one. But, the markets had a great rally. I mean, just go into that a little. I mean, is it the fact that he can't fill out the cabinet? It's a revolving door as far as the administration. Is it the tariffs? What's the basis for that statement?
Well, let's start from the beginning. November 2016, the market had been down 9 straight days before the election. Trump wins, and we get a really good rally, and some of the positives of the Trump administration start to affect the stock market. You get a reduction in onerous regulations. You get a whiff of tax relief. You get a pro-business environment. Confidence goes up. You get a good stock market. And the economy goes from 2+% GDP growth to 3.5. Now, all those bullets are spent. You've got a Democratic Congress coming in. Now, I, for one, thought that that would be bullish because we'd have gridlock. But I think what people are now realizing is it's going to get more acrimonious. Trump doesn't just sit at his desk and say, okay, you know, my easy days are over. He lashes back out. So you've had firings. You've had threats of firing with the Powell situation. You've had denials. You've had threats against Mnuchin. You've had denials. You've had pacts with our allies that have been broken. You've had promises to Congress broken. It's endless. So in most down waves, particularly the ones that aren't recession oriented, 1987, you knew why. It was portfolio insurance. 1998, you knew why. Long-term capital, or the 1997, the Thai baht. When you can pinpoint the actual reason, then you can put money to work because you know eventually that's going to get resolved. Here, we're dealing with a moving target. The tectonic plates are shifting, and people are nervous. I mean, we talk to institutional all the way down to novice investors. And they're not asking, what should I do? They're saying, when is this going to end? And I can't tell them when it's going to end. I'm just telling them it's going to end in the shape of letter W. We've had record numbers of new lows in the S&P 500 beyond what we saw in 08, 2000, 1990, 87. If you're looking for an analog to these markets, it's either 1987 or 1990. But even in 1990, we had the Gulf War. We knew that would be over. And ultimately, that was the first recession for a long time. So I think there really is a crisis of confidence. And I don't see that ending because we've got a mercurial president. Nobody much minded when the market was making new highs. But now that the market's making new lows, people are zeroing in on that. And that's very disturbing to everybody from the big institutions all the way down to the individual investor.
Mark, there's problems elsewhere too, and I just keep looking and I keep bringing it up. Even for the last year, I've been bringing it up is Europe. I mean, I look at these European banks and I think, what is going on over there? I mean, Deutsche Bank is $7 here now. You can keep looking, and whether it's Brexit, you know, with Barclays, or you know, there's got to be more happening here because these stocks are not just making 52-week lows. Some of these are making decade lows in the case of Deutsche Bank. Like there's problems there.
And also you have now the perceived credit crisis in low credit bonds here in the U.S. You had the Guggenheim analyst Menard talking about that. These things are all issues that have to get resolved. But remember, we lived through the Greek crisis. We lived through the Italian banking crisis and the BRICS and so forth. Those things the market can deal with. It's the uncertainty of the next tweet or the next, what triggered yesterday's rally? The head of the Council of Economic Advisors said, oh, don't worry, Mnuchin's job is safe or Powell's job is safe. Well, if the market rallies hinge on a random comment like that, people are just not going to put their money to work. And there's an enormous amount of money on the sidelines. And eventually the HFTs will go from selling to buying. They're just pouring fuel on dousing on the flames. So, that's another thing that we're dealing with now. And here's one final thing that we haven't witnessed. From 2009 on, we had zero interest rates, basically. When you have zero interest rates, you don't get those old sell programs in the S&P where prices get out of line and arbitrageurs come in. It's only when you have interest rates at 2 or plus % that it makes sense for them to do it, because that creates the premium in the S&P. There was basically no premium in the S&P futures for years. Now, that's a little bit of inside baseball, but the reason it's important is, in addition to the HFTs, we're now seeing arbitrage type sell programs, which create incredible tick extremes. Yesterday, I happened to be on the upside. So the internal forces of the market.
You're talking about the cash markets versus the futures markets and buying all the stocks within the dividend difference and the interest difference, correct?
Exactly. When interest rates are zero, there's really no incentive to do that.
Yeah,
because
100%.
Premiums. So you trade those markets, so you know that. My bottom line is, if you're a long-term investor, stay with your plan. If you put money to work, I coined a phrase, buy the dives instead of buy the dips, because the dips are silly these days. They turn into waterfalls. If you've done that and you've got losses, sell down to your risk tolerance. If you've got cash on the sidelines, sit on it and look for bargains. But there is one bright light here. A lot of the stocks that are the growth names that we know will do well going forward because they have good, unique business models like Salesforce.com, like Visa, like Adobe, some of the healthcare stocks like Centene and WellCare. These stocks have been beaten down. Microsoft, interestingly, fits that category. In the Chaikin Power Gauge rating, they have what's known as a neutral plus rating. That means that the 20 factors underlying the rating are bullish, but the stocks are in a downtrend. These are the stocks you want to put on a wish list. You want high beta stocks, to my mind, not the defensive stocks. If you're putting money into defensive stocks, and by the way, the staples took a huge hit in the last week, undoing a lot of the good. I don't think you want to, if you're parking money, park it in the money market fund where you get 2% and no capital at risk, because that's what you can get right now. If you want to put money to work on extreme weakness, do it in the stocks that made new highs in September with high beta and good underlying fundamentals with unique business models. You're not going to catch the exact bottom. I think Salesforce is great because it didn't make a new low on Monday with the market, but Visa announced a small European acquisition this morning. They're doing incredible things in electronic payments. They've got a great franchise. These are the stocks which you can buy them on sale. Be prepared to see them go 5 to 10% below what you paid for them. Avoid the stocks with bearish power gauge ratings like Netflix and Apple. Apple still can't get out of the negative climate that they created with financial analysts because of the lack of transparency. So, be selective, but we've got a shopping list of 15 names that actually Sandy created by overlaying the high beta screen on my screen, which looks for positive earnings estimate trends, analysts and experts bullish, and a neutral plus rating with stocks that had previously made new highs with the market in September. You can find opportunity here, but you have to be extremely disciplined and be selective.
We've been on the line with Marc Chaikin. He's the founder of Chaikin Analytics, joins our show a couple times a month to give us his technical and fundamental outlooks on the market from his vast years of experience. Marc, thanks a lot. Have a good new year. We'll be talking to you after, and I'm sure we got a lot to talk about in 2019. Thanks again, Marc.
All the best, Joel. Dennis, thanks very much.
Thanks, Marc. Always appreciate your commentary.
Bye-bye.
So, Dennis, you're safe over there in Canada, right?
Safe from what? Canada's market's been hit harder than the U.S., in my opinion. I see some of those Canadian ETFs I have, and those things have just been brutally hit. And that's because of oil. I mean, Canada, we know, is oil economy. It's obviously a lot of commodity-based. Commodities have been hit. I mean, gold helps a little bit, but oil has just been hit so hard here that you see a lot of these Canadian stocks, and they've been hit. You look at even the Canadian bank stocks like BNS, Bank of Nova Scotia, nice rally yesterday, but $60 in October down to $48. You can look at Bank of Montreal, you can look at Royal Bank. All these things have been hit really hard, just along with oil prices probably, and the overall markets as well. So, but the one downside of the Canadian stocks, they didn't really have the 200% rally that the U.S. stocks did over the last 6 years. So they've rallied a bit, but they were really, in the last 5 years, you start analyzing a lot of those Canadian ETFs, a lot of them aren't even up. And that's, because oil really, we were 100, if we go back, we're $100 a barrel, and you're sitting at 45 here. So I guess it's not unexpected when you're an oil economy that you're going to see your stocks underperform and when oil gets hit.
And what about that rally in oil yesterday? I mean, finally, woke up.
Needed it.
Yeah.
I mean, but you look at the chart, bring up the USO. You know, we can just look at that because everybody trades.
Sure.
You don't have to, you know, futures quotes. Like I don't like paying for futures quotes. You just look at that. But you can just see here, that huge rally we have yesterday looks like a blip on the chart. It looks like nothing. It looks like it didn't even like it looks like normal trading. And if we look at all these rallies that we had on a lot of these different stocks, you know, 1,000-point Dow rally, and you look at the rally on a lot of these charts, and they all kind of just look like, oh, this is just normal trading. It doesn't look like an outsized move at all. Well, I mean, yeah, you know, it was a nice rally yesterday, but look at the chart of Apple. We got back to where we were 3 days ago. Look at the chart of, you know, you can bring up anyone you want. Look at the chart of Square. This is where we were 2 days ago, $54, $55. So yeah, we get an awesome rally. Yeah, it's going to make some major headlines, but put it in perspective, it's nothing compared to how hard we've sold off. So, and now, you know, they see them selling a little bit here this morning. That's not good news either. But I'm going to say today is a very important day. And I'm very much on the fence going forward here. Just, I don't know if there's more rally to come here or not. Maybe it's not unexpected. We see a little profit taking after a huge day yesterday. You have some nervous Nellies. The question is, do we have people who are sitting with cash on the sideline saying, okay, I'm going to buy this pullback? And do they buy us up, and do we close green today? We can close green today.
Great.
Okay, maybe we got something cooking. But if we decide to start leaking this and we leak further, we get back half or 2/3 of the gains from yesterday. That's terrible news for the market. So the bears are still firmly in control. And obviously, the bulls here still have a lot of work to do.
The bulls did a little kicking yesterday. Dennis, you to play individual Canadian oil stocks, or do you kind of go broad with an ETF, Rocket 50?
No, okay, so this is investment style. I trade everything. We know, you know, there's nothing I don't trade. So I trade lots of individual stocks, you know, Suncor, CNQ, which is SU, CNQ, two of the big ones there over in Canada, but there's a ton of them. I mean, there's a ton of Canadian oil stocks if you want to, you know, look into smaller ones there too. Those are probably two of the biggest, SU and CNQ in Canada. And I'm invested in some Canadian ETFs, but most of your Canadian ETFs, even the broad-based ones, will have like 25% oil related stocks in them. And I'll go as far to say even the Canadian banks at a certain point in time are somewhat oil plays when oil really goes into the doldrums. We saw this back in 2016. A lot of your Canadian banks got hit hard. Why? Because they got all loans to a lot of oil companies, especially a company like BNS, which is Bank of Nova Scotia. If oil really gets hit hard, that starts to get hit too, because they've got a lot of money loaned to oil companies. So it's overall exposure. And, you know, at a certain point in time, if companies start going bankrupt, there can be credit risk there too. Now, we're not even close to that. I mean, you know, obviously we're significantly above where we were when we were $25 a barrel. But we were talking about this in 2016. We got down to $25, $26 a barrel. There was some concerns that some of these Canadian oil companies might go, obviously, off the board or bankrupt. And that's going to leave some of these banks hanging on some, you know, bad loans. But, you know, those concerns aren't here yet. And I'm not saying that's happening, but at a certain point in time when oil continues to fall, people start getting concerned and they start hitting the Canadian banks even harder. So if you're invested in Canada, you've got Canadian ETFs, you've got oil exposure. That's what you need to know.
All right, let's talk. We got about 30 seconds here before we go to our next guest. Just let's talk Tesla here. And it's been a huge trading range. I mean, that stock held up really well when the market was cratering. And now Dennis, back to 300, got a little double bottom here at 294, 295. If you want to lean on that for a swing trade, but it's been a trading range in this stock for quite some time here, really from like 250, 260. Actually, if you go all the way back to the earlier in the year, it's been the trading range here. Dennis, you're going to use this sell off to get back in Tesla.
Well, and you know what? The funny thing you say, I was talking with my wife yesterday, and we just talk, you know, stocks every once in a while. And I was like, this is the one stock that I would like. The one stock that I kind of want in my portfolio. I've always joked, when I have it in my portfolio, I want it out. And when I don't have it in my portfolio, I want it in. I'm kind of still a Tesla bull here. So I think this is one, and Marc was saying it too, and he said something great on the show. What stocks were making highs back in October? And this one wasn't, but it made highs in December even.
Crazy.
So the relative strength of this one is fantastic. If the market goes to take off, I think Tesla takes off with it.
All right,
and
Dennis,
Tesla maybe leads the charge.
So sorry to interrupt you. 8:35. We got Ivan Feinseth coming on.
Go grab Ivan, and we can pick up the Tesla talk after.
Okay. All right. We'll take a quick break. Be back with Ivan Feinseth, partner and CIO of Tigress Financial Partners. Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elconin, along with Dennis Dick. We are on the line with Ivan Feinseth, partner and CIO of Tigress Financial Partners. So what is your 20 years experience on Wall Street telling you about this market?
That this pullback is an incredible buying opportunity.
The pullback today or the overall pullback?
Well, the pullback we've experienced since the first week in October. This sell-off, it is somewhat technical. I think it is driven by, well, first of all, I think we have an incredible disconnect between the strength of the economy and the weakness in the market. And when that happens, when you have that divergence, it's a buying opportunity. But when you have just this technical and computer and in many cases forced selling because of margin calls and redemptions, it creates a buying opportunity.
Okay, so where you looking at? I mean, there's a lot of things that have been hit. Your FANG's been hit, your Facebook, your oil stocks have been hit. Where, if there's a couple sectors that are, piquing your interest, what are they?
I would say first is tech. It had the biggest run up. It had the biggest pullback. It's still where the biggest opportunity is. Tech is the engine that drives the U.S. and global economy. And then the other area are industrials. I have been negative on oil for some time and still believe oil will trade in the low 40s. So I don't really see opportunity in the oil stocks.
So
I think the lower oil price is actually benefiting everything else.
So let's go to the retail sector, and seems like everyone did a lot of Christmas shopping here, and Amazon's not going to put everyone out of business. Where are you looking at? What individual issues are you looking at in the retail sector?
My favorite retailers are Costco, Macy's, Nordstrom's, Target, and also Amazon.
And pretty good mixture there. Let's start with Costco here. Looking at it on the chart, we've had a nice haircut here coming in. Nice candle yesterday here. Give us the fundamental outlook here. I mean, should we lean on this, try and buy closer to the low of the move here, or should we use that as a potential stop out point? Tell us what you think here about Costco.
I think it's a buy right here.
Okay.
There's two issues. First of all, they have an incredible consistent gain in same-store sales, and people still pay for the right to shop there. They have a very loyal customer base. They've had good growth, and the two key drivers are their value proposition and the treasure hunt experience, because when you go into a Costco, while there is a lot of core product that people do go on a consistent basis to buy, a lot of staple goods, usually when you go in on a weekly basis, you never know what you're going to find. And that continues to draw customers in the store, continues to have customers go down all of the aisles. The longer somebody stays in a store, the more likely they're to buy more things.
Isn't that frustrating though? Isn't that frustrating though, that sometimes you go there and you can't find the same thing? I mean, I think I would say, we really spread our shopping out. And I would say that's where I spend my most money, because when I go there, I spend $300, $400, $500 bones. But don't you think is it just because of the availability and the low prices, or do you think that that's kind of like a planned thing that they do to keep you coming back?
It's kind of both. They want to turn their inventory, and they do. For example, right after Christmas, you go in, they have no more toys. Toys are gone. Actually, in the spring, they focus on furniture. And so the turn of the inventory does bring people in, and they have a value proposition that if they can't get the specific item at the right price, then sometimes they forego it for a period of time. Okay. Or they have a brand substitution, but they have a significant selection of branded products, as well as their own in-house products currently.
All right, and the fundamentals behind Macy's here. That stock had a nice recovery, but it's pulled back a bit. Trading right at the $30 level. Comments on Macy's?
Just that they have evolved into a incredible omni-channel retailer, where you can buy in the store, take home from the store, buy in the store, have it fulfilled online, buy online, pick up in the store, and great online presence too, and they've really done well with their My Macy's customer loyalty program. They coupon well, they connect with the consumer well, they leverage the value of their loyalty program members.
What are you avoiding? You mentioned the oil patch, low 40s. We did hit that yesterday. What sectors are you avoiding?
Healthcare, personally, because I don't have a lot of experience in that area. And second is oil, because I think everybody likes lower oil prices. I personally do, but the world is awash in oil, and the U.S. is now the Saudi Arabia of oil. We are the world's largest producer of oil. The shale oil has created a huge increase in supply. Then you have other, countries, Russia. Even they're not an OPEC member, but they meet with OPEC, and then they just do what they want. They pump what they want, and they continue to pump oil. Also, Venezuela is desperate for money, so they need to pump as much as they can. So I've called for some time that eventually OPEC kind of breaks up, because they will lose members. They did lose, one member. It was not the one I thought, but Qatar has already left. So OPEC's strength is declining. Their ability to control oil prices is declining. So I think oil prices will be low for some time. And I'm also a believer that people should be driving more electric cars and powering their houses with solar power. And this trend is going to continue, which will eventually further cause the decline in oil prices.
Hey, Ivan, Dennis Dick, I just want to take it over to the tech stocks there, because you said you like tech, as well. Give us a few picks there. What are you looking at in tech?
There are just so many that the value is incredible. I mean, Apple and Google and Microsoft and Intel and a couple of other chip stocks I like, Qorvo and Skyworks and Qualcomm. Just the opportunity in tech is huge, because there's just the themes in tech. Cloud migration is still intact. There's the value is incredible right now in tech, and these are the companies in the sector that has the strongest growth rates.
What about a stock like Facebook? Just questions, because we get that one all the time. It's one that's obviously out of favor. Some stuff's happened there, but with data breaches. But what are your thoughts here on Facebook?
Yes. Incredible buy. You should be buying Facebook with both hands. They continue to increase their monthly active users, and advertisers go to where the people are. And digital ad spending is growing as an increasing percentage of the total ad market. Excuse me. And it's also growing because it's a more effective way for advertisers to measure their return on their invested advertising dollar.
We've been on the line with Ivan Feinseth, partner and CIO of Tigress Financial Parties, trying to get us bullish here on Benzinga's Pre-Market Prep Show. Ivan, we always enjoy your input. Have a happy new year. We'll be talking to you in 2019.
You too. Thank you very much.
All right. We are just hanging out in the 24.30 handle, actually down 36.75 at 24.34.50. We just move around in these handles so much, Dennis. It's hard for me. Remember, I had the handleitis on the way up, and now I'm having
you can get handleitis right now very easily. You have handleitis a little bit all the time, Joel. You get handleitis right now. I get handleitis right now. What handle are we in? Because this, and what handle, if you're newer to trading, was talking about the digits before the decimal point is what we're talking about when we say the handle. So stocks at 25.52. The handle is 25.
So how do you like that? We have a bearish guest and then a bullish guest. And then
I know, now I'm really mixing. I was mixed coming in here too. Chaikin had me leaning a little bit. Okay. He's got me leaning more to the bear side of hat. I almost put the bear hat on there. And now I've got the bull hat here coming back on. So, I'm really leaning on the fence here now. Like yesterday, it was a little bit easier because we were so oversold. But now we've had a pretty good rally.
This is good.
So now it's like the true test. Now it's tricky. It gets tricky here. Obviously, from a day trading perspective, I'm just playing, a lot of, different inefficiency strategies. So those work very well. But I'm trying to keep the investing hat on here quite a bit. And, I've said, every show I will say, I've got quite a bit of cash I'm still sitting on. I want to put some of that cash to work. Ivan gets me thinking, I did buy a little Facebook. I'm obviously very early on it. But, I'm undersized in a lot of my tech or a lot of my investment portfolio, and I do need to eventually put some of this cash to work. Should I nibble here? Is the bottom in? I think I'm going to get another chance here. So I don't think I'm chasing. I don't think I'm coming here with investment dollars today, even though it's a little pullback. And if you really think the bottom was yesterday, then you're probably coming in here today. But I kind of agree with Marc. I think it's going to be a process. He said, you know, he thinks it's going to be a W bottom. I think in this case, it might be too. There's so many concerns, so many other unknowns out there. I don't think we're going straight back up. So I'm not that worried about not getting those dollars invested in. I was more worried that we could have more downside there and looking to maybe, you know, sell more of the rip as opposed to buy the dip of my investment portfolio. But a stock like Tesla too, I'm still, you know, and we were talking about that right before Ivan came on. And yeah, you know, we've sold off significantly, got under $300 2 days ago. Kind of ripped the rip your face off rally there yesterday, closing right near the highs up near 326. We're pulling back $9-10. Lower 300s, I like Tesla.
Dennis, got a quick question. I want to get out of here before Gene Munster. And this is from Risk Slayer. He said, this is at Triple D. You've explained your strategy where you buy an outside move looking for a 2-day follow through. And he's asking specifically on Amazon and Facebook today. I'd just say little bit of different market conditions. I think a lot of that strategy was when, you know, the market was churning higher every day and something turned. But is that a strategy that holds?
2-day move I employ. It's a little tricky in this market. You're right. We're not normal markets. So some of the strategies, you know, and I haven't done a lot of strategies I've talked about on the show. And you can't use them all. It would not have worked. So my 2-day move would have already been, we had an outsized move yesterday, which was counter trend. So usually you see follow through the next day. We're not seeing that at all here in the pre-market. We're not seeing follow through. And I think the whole thing is it's just too much. There's just been obviously too many people underwater. So they're using this as a selling opportunity there. Do we see some follow through here and continue? I mean, if you do believe in the full 2-day move, you'd be buying this pullback here this morning. But I think there's too many people who are nervous here. I think we have more nervous longs than nervous shorts, and that's what the market's showing us. And even when I made that prediction yesterday, if you rewind the tape to where we replayed it, I was saying I think we're going to get a 1,000-point down rally, but I think it's going to be met with sellers, and I was going to use that rally to sell. I guess apparently everybody else beat me to it because I didn't sell anything out of my portfolio yet. I was hoping we'd be up here at least for a few hours. And I was traveling yesterday, and I didn't get a chance to sell the stocks out of my portfolio yesterday. So I was coming here this morning with my selling shoes on. I tweeted with a couple of people last night, and one guy sent me a nice pair of Christmas selling shoes there on Twitter, jokingly. And then I come in this morning, and the opportunity is already gone. So I think we get anywhere near yesterday's highs. I'm probably going to lighten up, and I'll be lightening up stocks like AbbVie. I have this in my portfolio. I sold half of it. It's held up better. Some of the defensive stocks like really came back. Abbott Labs, ABT, I've had this forever. It got back half of its losses yesterday. That's one that I'm looking to lighten up into this rally here. So that's, but the 2-day move is typically just that you could follow through from the counter trend move from the previous day. We are not seeing that here this morning, so I don't think it's going to work.
All right, let's take another quick break here and bring in one of our top analysts, top guests, Gene Munster, managing partner at Loup Ventures. He published a very interesting piece yesterday, and we're going to talk to Gene about his predictions for 2019. We'll be right back with Gene Munster. Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. We are on the line here with Gene Munster. He's the managing partner of Loup Ventures. And Gene, I saw you on TV the other day, and you had that nice beard. Are you hunkering down for a really cold Minnesota winter?
I think I am. Yeah, we're trying it out. So far, so good. I'd say it's somewhere between scruff and a beard at this point, Joel, but to be determined.
Okay. Just real quick, you put out a really great email yesterday, recapping your 2018 predictions. Why don't you take one that you thought was your best one and one that was your worst one?
Well, for 2018, I think it's important that the worst one was related to Amazon and Target. We felt strongly that this combination would happen. We're incorrect on that, incorrect on the timing, but still believe these two companies should fit together. The biggest reason is that ultimately Amazon has aspirations in brick and mortar retail. If you think about retail more broadly, 5-10 years from now, it's going to be both online and offline. And I think that combination makes a ton of sense. And so we think they're going to continue to aggressively pursue that. As far as the best prediction, I think we got 6 or 7 of them right, but that Target one really kind of stung. And so
that's okay.
We'll just leave it at that. We have things to learn.
And you did call the Bitcoin pullback. I remember talking with you that on the show. And I think the other one that I just have to marvel at is that you said that Model 3 production would ramp up from 2,500 in 2017 to 150,000 in 2018. And they produced 149,500, Gene. You missed it by 500.
Well, I'm glad we got that one right. It was quite a controversial name for other reasons that we didn't predict. They got the production number on track. Obviously, something that we did not anticipate with some of Elon Musk's behavior. I know Joel and Dennis, you and I we've all talked about kind of Tesla more from a higher level. I would say that we're still big believers in that story, but believe that Elon's behavior is unpredictable. And I think that that piece that we missed in 2018, that being Elon's behavior, will probably continue to be a wild card for the Tesla story in the years to come.
So you basically have had a trading range in that. I mean, for the longest time, between 250, 260, 370, 380. Are you just trying to look at it from a trading range, or do you like it under 300 or at 300?
I think when it comes to Tesla, this is just a story that you simply need to own and not really sweat the month to month. I know from a trading perspective, that probably doesn't make a ton of sense, but from an investing perspective, that's what makes the most sense. The reason is you see the fluctuations in the stock in the near term. It just makes it difficult to trade week to week. But the reason why we're so optimistic longer term is we think this has the best product roadmap in tech, just everything around EVs. Just 2% of cars sold in the U.S. today are electric, and eventually that's going to be 100%. And then separately is the energy capture with the panels and the energy storage. So this company, I think, really rides a massive change in really human behavior over the next decade. And so that's why we continue to like it. We would like it above 300 and below 300. I think this stock has the potential to be multiple times higher than it is today.
Gene, cash flow positive last quarter. Does that continue for them here now? Or, obviously they continue to expand here. Are they going to need to continue to borrow here can they finance this internally going forward?
They've been clear, which you have to take that with a grain of salt, that they do not need to raise money. I don't believe they're fully in the clear, if you will, that they are going to ever have to go back to the markets. I think that there will be a point where it could be fluctuations about what happens with demand with Model 3 when these tax credits start to wear off next year. They obviously are offsetting that with rolling Model 3 out to new countries. But I think you could see a point where they maybe dip back into negative territory, cash burn territory. But I think that would be just temporarily. The bigger picture here is that this cash crisis appears to have passed. And I think that they will reach kind of escape velocity. And that's when you don't even have to think about this sometime in the next 4 quarters.
What about Apple? Obviously been hit very hard in the last quarter. I mean, nothing's been hit really harder than Apple. It's down over 30% here since October. And, some of that last quarter, and, they obviously aren't going to be giving as much transparency going forward. And I think, that obviously hit the stock as well. But what are your thoughts here on Apple at $155? I mean, from a valuation perspective, it's got to be getting cheap.
Yeah, this is our first prediction for 2019 is that Apple is going to be the best performing FANG stock. And part of the reason, and I want to make it clear that we think that there is risk to the March numbers based on what I think is more of just soft smartphone demand in some emerging markets. But I don't think there's anything structurally wrong with the iPhone franchise. And I do believe that this has an opportunity to be, let's say, twice as high as it is today in terms of the stock price. But just the quick take is that over the next year, you're going to see investors increasingly focused on revenue and earnings growth. In the past, I've always focused and other investors on iPhone units. And now that they're not giving that disclosure, I think that will change the scope of this to investors looking at what is more powerful. I also believe that Apple is aggressively buying stock back. And the last piece to this being our top prediction for 2019, that being Apple being the best performer, is this emerging theme around 5G. So 5G, for those of you who aren't as familiar with it, this is going to be a massive leap forward in terms of the speed of your internet, your data access on your phone. Think of it as anywhere between 10 and 100 times faster than your current download speeds. So that's probably going to get rolled out in 2020 in the US, 2021. They're starting to roll out a little bit today. But I think in 2019, Apple will increasingly be thought of as a way to play 5G because it will spur an upgrade cycle. So at the end of the day, we think that this is going to be an outperforming type of a year for Apple stock.
I'll keep that in mind. Also, one of your predictions, legislation to regulate tech company data usage will be introduced and passed. So I know you've been a little negative on Facebook, maybe perhaps Twitter here. Just make your comments about the regulation of data usage.
So this, we've heard chatter about it in 2018. It will, as you said, Joel, we think that it's going to be, the substance of it is going to start to impact some companies, especially Facebook, and to a lesser extent, Twitter, maybe a little bit Google too. The way it's going to play out is there will likely be greater disclosures that those companies will have to let users know about how their data is being used. Now, many of us won't even think twice. We'll just hit okay, acknowledge, and move on. But I think you are going to see some people starting to change their behavior around how they use some of these. And we expect in the U.S., the amount of daily active users in Facebook to decline for the first time in 2019. So that legislation, we think, will have a negative impact on user growth and engagement. And obviously, that's not good for Facebook advertising business as well. There's another just quick point. We don't think the world is a better place because of Facebook and Instagram. People generally don't feel better about themselves using it. So we also think that one of the top resolutions in 2019 is going to be for people to use less tech, and Instagram and Facebook are two areas that are easy targets for people to use less of.
We've been on the line with Gene Munster, who's the managing partner of Loup Ventures, giving us some tech predictions for 2019 during this busy holiday season. I'm really glad you can make it on again today, Gene, and we'll be talking to you in 2019 following these predictions. Thanks a lot.
Thanks, Gene.
Thank you.
All right. S&P is continuing to slide here, down 38.50 at 2432.50. That pre-market low, 2422.50. All right, we are going to take a quick break here and bring in one of our more colorful guests, and we're going to bring him in via Skype video. Fari Hamzei from Hamzei Analytics. We'll be right back. Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. We are on the line with Fari Hamzei of Hamzei Analytics. Fari, you are looking dapper today. Did you get all dressed up for the show?
I even shaved, and I put a special cologne on, so I smell good on Benzinga Skype.
And where's Tico? Where's Captain Tico?
Tico is sleepy. I sent some pictures. He's sleepy. This guy, he doesn't have to work as hard as you and I. So he makes one call, goes to bed. That's it.
All right, we got to talk about the overall markets here, and I can attest, Fari, that you were out ahead of this break here with your indicators here and stuff. What kind of where are we at with your?
May I share a screen?
Share a screen.
Yeah,
All
sure.
right, great. We're gonna do it.
So let me
Go ahead.
do this.
High tech Fari.
My display 5. Which one is which? Wait a second. This is showing you guys. I'm gonna display this one. Okay. Do you see my screen there?
We sure do.
Yeah, we do.
Okay. This is the S&P 500, and I'll walk back into weekly. We came to a 200-week support. Bounced off of it last night. Here's the daily. We're still on a sell and a sell. I'm sorry, a buy. I'm sorry, sell and a sell. Sell on the weekly, sell on the daily. We had a huge 52 weeks low that we haven't had in a long time. I don't remember 240 in a long time. So it says we're near the bottom. Here, Momo hit negative 16. Haven't seen that since 2008. This was a massive drawdown. Here's another angle. Look at the D-trenders. These are in my PMT. I believe you guys get it, the PMT newsletter. You could, if you look at these levels we were at, this is that low down there was what? Negative 19. It's on negative 21, I think is the all-time low. Okay, so when you get to these levels, we have a buy. Now, I just noticed that we're down with 400 points again, near 400 points on the Dow, and overnight. I wrote the other day, and it was also on the same program you're on, Joel, on the stocks and bonds. And I said the following, fundamentals are very good. Believe it or not, the sales are strong, earnings are good, interest rates are relatively low, but they're not buying it here. Hello, point one. Point two, technicals, they're not responding. Look, let me give you another one. Let's go to look at this one, this reading. This was 3. This is SP2. This is what been around since 1995. We don't see 3s. Plus, it's a 0 to 100, okay? The buys at 25, sells at 75. If you go back, you see how well this marked the market. I won't get inside of it what it does, but we never seen a 3. Okay, we bounced yesterday, but wait a second. How come we're down 400 points? We're about even for the week now. We're about where we were Friday night. So technicals are not responding. So fundamentals are not responding. I look at my White House bulls. They're all crying. Right? I want to buy, but I got to walk around with a jar of Vaseline. What's going on here? Hey, that's your problem, not mine. I'll be on the sell side. Technicals are not responding. Okay? So the only thing left is the confidence issue, the sentiment. We're trading on sentiment. Look at the discount we have here. Look at this right there. This kind of VIX futures last night closed still with a contango. That means we're not done. Now, why do we have this issue? I think it's a confidence in everything. We have a confidence in the government that's lacking, confidence in our institutions. Who brought that in? Don't look at me. Go to Washington. Look at the two ends of the Pennsylvania Avenue. Until that goes away, I'm afraid we're in this malaise. If you look at 2008, 2009, I'm working on an analog to that. The similar the Q3, I'm saying Q4 versus Q4. If you use that, we'll probably have another 8 weeks of this pain. And also, the pain that's ahead is far more greater than we've already seen.
So
That's the only way this gets crushed.
You think it's going to be an ugly January?
I think we won't turn around until, here's a test. Good question, Dennis. Look what they do with the new 201k money. There's no 401k. That's a myth. After 2008, 2009, really, the accounts are half. So it's 2001. It's a 201k. Now, and that's why there's a move to futures and options. People have less money, so they get more aggressive, which is very risky. But not everybody's ready to do that. But they move up the risk ladder because they have no other choice. The capital base is smaller. I understand that. It's math. But When that money comes, second, third, and fourth, next week, watch what they do with that money. If they keep that money, we go up, it's a good sign. But if they sell into it, watch out. The smart money knows something. And if I'm right, I hope I'm wrong for the sake of the nation, but if I'm right, we have another 8 to 10 weeks of bloody mess. And if you think this was bad, wait until then. Usually you get to this stuff when sentiment takes over. There is no measures. You can't say it's here or there. You just have to have blood on the streets. Remember, let's see, Getty. Getty said, I'm going to buy when there's absolute blood on the streets. He would go to a restaurant, wait till 5 minutes before they close, go in there and ask for a discount. Why? He was the richest man in the world at the time. But that's John Paul Getty. We're going to wait for, that's my sister. My sister, you know. I said, Nahi, what are you doing? She goes, well, she runs a bunch of hotels. She says, Fari, I got the checkbook out, but this son of a bitches, they want too much money from me. I'm going to write it. I'm going to give her a few shekels right now. Option them up a little bit. Yeah, she's from a different tribe. She's not with me. Yeah, okay. I'm agnostic. She's a different tribe. She goes, I'm going to option them up right now and then hit them with my number later. I said, okay. You know better. You're running 700 hotels. Remember, asset will gyrate to the best managers. If you're managing that kind of money, you know, bigger each hotel is about 50 mil. If you're running that kind of money, you must know something.
If you're nervous about this market, are you bullish on gold then? Because gold seems to be catching a bit every time the market's selling off. What do you think of gold and silver?
Okay. Excellent question again. Jesus, you're on a hot run here, my friend. I'm not.
It's usually Joel that asks you.
I'm just want to say, I'm not a gold or silver guy, but we do run a OTF on it on the time frame. And if you look at it carefully, you see that the big money is nibbling in. We haven't seen any big runs, but it's positive. That's one of the signals you want to watch. Yeah, the gold. Yeah, I'm not sure about silver. Silver is more of a little bit cheaper. It's a poor man's gold, but also is industrial usage. So you have some mix in the signaling. But gold is really a fear issue. So.
All right, Fari, let's just talk about oil. I just had a big old rally yesterday, and as Dennis mentioned on the chart, it really didn't look like much here. What about oil going forward here, trading down 86 cents at 45.34?
Well, here's let me show you a quick look at fractals quickly. This is what we watch the big guys versus the small guys on the hedge fund area, from the biggest to the smallest. They're beginning to buy some. We had a cross there that was trying to meet. It got there, pulling up. This is a G contract. And we get rid of mom and pops. Mom and pops don't know what they're doing. The sheep will always be slaughtered. But if you look at the large activity versus the small activity of the hedge funds, you'd see they made a bottom there. They're trying to pull up a little bit. The fastest guys, the most number of hedge funds are the smaller ones, they'll be selling it today. We'll see where it goes. We just really, these days, we stop doing long-term targets. These things have worked so well, these targets, and they're very adaptive. I'm lazy now. I just look at these. So same thing we did yesterday with NQs. We traded with NQs, with the OTF fractals. What that does is that, as you know, fractals what's regenerates itself in the marketplace. I mean, regenerates itself in nature. If you allow it to market, you're allowed to see or permit yourself to have a different view and looking at and say, okay, I've got the Soros of the world, I got Ray Dielos of the world, Julian Robertson versus a 2-bit mom and pop hedge fund on Chicago in Seabot building. Okay, they got to start somewhere. Listen, Soros started with 2 desks and 1 secretary. And I don't know where she sat because it was Jimmy was there too. Maybe she sat on Jimmy's lap. I don't know. But long story short, you got to start somewhere. The smallest guys yesterday were very jittery. Okay, let me show you the fractals real quick. This is the biggest guys. They bought this baby at actually Christmas Eve. Look where it went from one extreme to the other, and it constantly updates itself. So this was a huge run. I made some mistakes because I was looking at what the smaller guys, smaller hedge funds were doing. But the big guns, look how clean they held their process, and huge winners.
What is that you're showing
there? These were the close.
What are you showing there?
They start selling. Yes, sir.
What are you showing all the way over to the left?
This is the very, very large hedge funds. This is based on volume, block trades, and frequency. It's prop work we've done. It took OT up to the next level.
All right, Fari, before we let you go here, I know you're looking for the January here. S&P, let's just call the futures here 2430. When we have you on 1 year from now, Fari, I know that's hard because I know you like to file your
Well, let's talk about SPX a little bit easier.
Yeah, sure.
Let me bring SPX up for you. Here's the full SPX there. I think if you step back, you do it this way, boom. Or you come back and say, give me the monthly, all right? If you look at that.
Yep.
We have a rendezvous with destiny. It's called November 2016, the election time. Okay, right about here. I'm sorry, right about here. So it would be, I think we need to go there and look at 2100 on the S&Ps.
Okay.
I'm bearish this year. As reflected in my time and digest forecast for 2019.
Okay. All right. We've been on the line with Fari Hamzei of Hamzei Analytics. Joins the show to bring us his colorful analysis of the market and colorful charts as well. Happy holidays to you, Fari, and to your family, and look forward to speaking to you in 2019.
Thank you, Joel. Thank you, Dennis.
Thanks,
all
Marc.
the best to the Benzinga family.
All right. If you folks are wondering why Dennis is sticking around so much today, he's
Less positions.
less positions because of some computer issues. So
Yeah, I got one computer that's down right now, and I got to get that fixed. Obviously, today died on me this morning trying to fix it. And the second issue is that I was traveling yesterday, and I actually I didn't trade after hours. So I didn't have any overnight positions. So that's obviously, you gotta come in 50, 60 after hours trades from overnight positions, and have any. So yeah, I've got one stock right now. I only got one. So
you does not know what
one day trade anyway.
One day trade. And so we went bearish with Marc, and then we went bullish with Ivan.
Yeah.
Right. And then we went bullish with Gene.
Yeah.
And then we went bearish with Fari. Is that enough of a mix?
Yeah, so I'm kind of lost here entirely now here. So are we gonna have the tiebreaker here on at 9:15, Joel? Ryan Craver?
Yeah. Let's
break the tie.
Yeah, let's take a quick break. We're keeping you guys late today.
I'm actually probably not going to be on with Ryan because I do have to, 15 minutes before I'm probably going to go try to do something with the open here. So trading the open as opposed to, I don't have to get out of after hours trades. It's a little easier, but I go trade. So we're going to bring Ryan back on, and I'm going to say goodbye. We will talk to you guys in a few minutes because Ryan Craver's coming on.
Okay. All right. Quick break here. We'll be back with Ryan Craver, and he's our retail expert and founder of Commerce Canal. We'll be right back with Ryan. Welcome back, traders and investors, to Benzinga's Pre-Market Prep. We are on the line with Ryan Craver, retail expert and founder of Commerce Canal. Ryan, how you doing today?
Good morning, guys. How you doing on this short week?
Short week, but not short of trading action. Traders and investors to Benzinga's Pre-Market Prep. We are on the line with Ryan Craver. All right, Brian, we are getting a little bit of repeat here. Hey, we're good now? Tell us about Commerce Canal. That's a new company of yours.
Yeah, so we are representing roughly 50 brands on various marketplaces across the world. So we're doing their business for them on places like Amazon, which we talked quite a bit about, Walmart.com, Kohl's.com, Macy's.com, as well as selling into brick and mortar retailers like Costco and Macy's.
All right, so let's just get into this holiday season, and boy, the numbers are coming out pretty good, but I think just the malaise of the overall market is hanging over these retail stocks. Let's talk about the retail season, what you saw, what your takeaways are, good and bad.
Yeah, so I think a lot of the themes that we've talked about previously are still in play. So we are seeing some very strong consumer spending. We saw the MasterCard Pulse survey come out. It was very, very strong for both brick and mortar and e-commerce, which we knew would happen. I think what we are seeing is some inventory levels for some of the traditional retailers is being elevated. And we're seeing a lot of that business move to e-commerce. So nothing new here. I think we had a little bit of a bounce because people had priced in so much pessimism around this Q4, but the Q4 came out fantastic. There's a lot of names that are still doing quite well relative to their highs. So I think retail did very, very well and will continue to do well. I think we're going to continue to see the top line do well, but the bottom line do the e-commerce push and all the cost of transportation struggle.
All right, so who is leading the way here in the e-commerce, the transition? One of our previous guests talked about Macy's, and they thought that they were kind of, being able to, online, in-store, offer customers. Talk about some of the companies, a few of the companies that are getting it right.
Yeah, so I'm not a big fan of Macy's. I think that Macy's is in that one sector that continues to struggle. They're still working through how many stores they should have in the near term and long term. So I think there's still going to be some more store closures. Department stores was also the one piece of the retail sector that struggled in the MasterCard survey. So I'm not a big fan of Macy's. If you look at more traditional retailers, I do like Target. I still believe Target is doing a fantastic job. I do think that they are going to have some profitability issues just because so much of that is moving to e-commerce, but they're doing very, very well. And they, are within 28% of their high. So I think that this is definitely one to pick up right here and now.
Okay.
If we look at the strongest comps in the business right now, it's definitely Costco. So Costco is near double digits, quarter over quarter, month over month, which is fantastic business for them. And then if we want to dip our toes into, the guys that are transitioning a lot of their business to direct to consumer, I really, really love Lululemon. I think Lululemon has enough of a product mix that they're expanding into, as well as they've got a customer that, is checking out in the $100+ shopping cart.
Let me throw a curveball at you here. Gene Munster of Loup Ventures was on our show earlier today, and for the longest time, he's been talking about that Amazon making the push into brick and mortar. And he actually thinks that Target would be a perfect match for them here. Do you see, Amazon, they made the acquisition, of course, of Whole Foods and whatnot. Do you see them making a further push into brick and mortar? And if you want to take out Target right now on a relative basis, it's quite a bit off. It's recent high. Any comments on Target and Amazon perhaps getting together?
I think it's the best fit for Amazon given their culture. I also think it's the best fit given their war against Walmart. I know that Gene had said that would happen in 2018, maybe 2019. I just don't see it happen. Call me skeptical. I just don't see it happening. I think it would be a fantastic fit, though. And I also think that it gives Amazon what they're truly looking for. They're looking for your overall wallet. And we don't spend the majority of our wallets on gifts. We don't spend the majority of our wallets on apparel. We spend it mainly within the grocery space. And Target has definitely been one of those who has pushed in the grocery space quite significantly, health and beauty as well.
All right, that's what are you avoiding here as far as retail stocks? Boy, a lot of them have really been beat up. Which ones do you think still have some more room to go on the downside?
So on the downside, traditional retailers, I'm not a big fan of anything related to department stores. I think there's a couple that might do okay just because they have a bit of a floor to them. So guys like Nordstrom will continue to play around the whole idea that they may go private, so they may never have the ability to go much lower than where they are now, or at least 5 to 10 points down. I don't like Macy's. I'm not a big fan of specialties, so guys like Urban Outfitters, Abercrombie, those types of guys. I do like the off-price sector. So you look at a guy like Burlington continues to trade very well. And then, to pull in something that might be a little controversial, I definitely like guys like stamps.com who are playing in the e-commerce space and continue to sell postage. Guys like Shopify who are building these e-commerce sites that are driving a lot of the spend.
All right. And someone wants to know, okay, let's go here to Nike. Matt and Beyond wants to know if you covered Nike, if you have any thoughts on Nike.
Nike has surprised me. I thought that we would continue to see a lot of the market share push over to Adidas. I thought that the Jordan brand was going to continue to struggle. With that said, they have turned around their product portfolio considerably. They are loud and proud about their move to e-commerce, which I think is a fantastic market-leading position. So they surprised me, and you can't dispute how well they've traded given all the weakness we've seen recently. So I do like Nike.
All right, I got a tough one for you here. Stitch Fix. The stock's $17.88. Boy, close to its all-time low here at $14.48. I don't know how in the heck we got to 50.
Yeah, no, I am not a big fan of Stitch Fix. So I think it had the initial push where we were going to use AI to drive a lot of our retail spend. I can't see how this business has strong enough margins until they have some sort of brick and mortar presence or they have much larger scale. I'm just not a big fan of the subscription box, whether it's personalized or not. I don't like Stitch Fix at this point.
And did you mention Urban there is one that you didn't like? Urban Outfitters, the pizza seller?
Urban Outfitters is in the apparel retailer. I think specialty's a little tough. I do believe, if you were forcing yourself into them, they're probably close to a bottom. I mean, they're 8% off their low, 52-week low, and they're, 35% off their 52-week high. But I can't get excited about Urban. There's not a lot of new store growth. There's not a lot of change in what they're doing.
How about Five Below, a stock that got above 130 here, got up to 136.13, and now under the 100 in double digits here. Any thoughts on Five Below?
Five Below is, they're doing a fantastic job. They're opening a bunch of stores. They are stealing market share from some of the traditional guys, as well as I would argue they're probably stealing some market share from the off-price guys. They have an exciting retail environment, so they get people really, really excited. They obviously have very little very little e-commerce. So they're going to continue to drive new stores, and I think that they've got several years of growth ahead of them.
All right, so let's take off your retail analyst hat and put on, macro, fundamental. I mean, if we are going into a recession, as the market seems to be indicating here, the retail people are going to have less money to spend, and that's definitely going to impact the retailers here. So I guess a lot of your stuff here is dependent on whether or not the economy here is actually going into a recession or not. So give us your macro fundamental outlook, because I mean that has to be taken into account when you're certainly looking at the retail sector.
Absolutely. I think Q1, Q2 might be difficult. I think seeing the best comp from Walmart in 10 years, seeing the best comp from Target in 13 years, that's not something we should get used to. So I think it's going to be difficult in Q1, Q2. With that said, I do believe a lot of that is priced into the market. If I was forced to play retail, I probably would stick to the big themes that you and I talk about a lot: the move to e-commerce, the direct to consumer, the move to advertising and streaming, and all those types of themes that we've talked about. I would stay away from the traditional brick and mortar retail guys that are looking at decreasing their store footprints. There is some business that they'll pick up from Toys R Us closing and Sears closing and all these other guys going bankrupt, but I don't think it's big enough to offset the declines they'll see naturally in their business.
We have been on the line with Ryan Craver, retail expert and founder of Commerce Capital, giving us a look at the retail sector. Ryan, great. Thanks for coming on before the end of the year. Great seeing you. Great talking to you. And we'll be dialing you up early in 2019.
Awesome. Happy holidays, everyone.
All right, S&P futures here going into the open. We are 8 points off that pre-market low of 24.2250. Underneath that, I mentioned the $2400 level. Mentioned that's the 50% retracement of the rally that you had here. So it's going to whip around like a ping pong ball between 2400 and 2480. Of course, closing green on today and taking out yesterday's high and closing above it would be a great thing for the market. So have a great day. Hope you enjoyed all of our guests and the input from Dennis, and we'll be back with you tomorrow morning.